Welcome to Multnomah Group's third quarter 2025 market commentary. I'm Karen Sanchez, a senior investment analyst with the firm. Our first section is on the economy. In the second quarter of 2025, the U.S. economy rose at an annualized pace of 3.8%. This is a reversal of the first quarter's contraction of 0.6%, which was primarily driven by an increase in imports as businesses sought to get ahead of new tariffs. Third quarter GDP numbers are due October 30th, but may be delayed by the government shutdown that began October 1st. Second quarter growth in GDP was driven by a significant increase in net export activity and an increase in consumer spending. Private investment detracted. Unemployment remained in a narrow range at 4.3% as of August. Wages grew at an annualized rate of 3.7%. Non-farm payrolls rose by 22,000 in August, down from 73,000 in July. This follows downward revisions to June's numbers, reflecting a softening labor market. Consumer sentiment regarding the economy, inflation, and personal finances continues to decline. The University of Michigan's September surveys of consumers found the index of consumer sentiment declined 21.4% over the last 12 months. Most of the decline was driven by changes in consumer expectations, as those surveyed reported a weakening outlook for their own incomes and personal finances. Consumers also highlighted frustration with persistent inflation. It is worth noting that sentiment differed between consumers with larger stock portfolios, where sentiment held steady, while consumers with smaller holdings or no stock holdings reported a decline. Inflation remains sticky. Through August, the Personal Consumption Expenditures Index, excluding food and energy, core PCE, rose 2.9%. This is the Fed's preferred measure of inflation, and they have long targeted a rate of 2%. The core Consumer Price Index rose 3.1% for the same period. There are some indications that tariffs are beginning to impact prices. However, the effect has, to date, been more muted than many feared. Fed comments indicate a view that tariffs' impact on inflation will be transitory as consumers become accustomed to higher prices. Next, we turn to the fixed income markets. After a 9-month pause, the Fed resumed rate cuts in September with a 25 basis point cut. This brings the Fed's target range down to 4 to 4.25%. The Fed meets again in late October and December. As of September 30th, the yield curve was little changed from last quarter. However, there was volatility within the third quarter as the market chased headlines on the economy, inflation, and labor markets in advance of the Fed's September rates announcement. The yield on 2-year treasuries was 3.6%. The yields on 5- and 10-year maturities stood at 3.74% and 4.16%, respectively. The yield on 30-year treasuries stood at 4.73%. The Bloomberg U.S. Aggregate Bond Index rose 2% during the third quarter. Most sectors posted gains, led by emerging markets up 4.4% and long government credit up 3.2%. Developed international bonds was the only negative sector, down 1.5%. This is a reversal from last quarter's activity when developed international bonds led returns. For the year through September 30th, the Bloomberg U.S. Aggregate Bond Index returned 2.9%, led by emerging markets debt up 7.8% and high yield up 7.3%. Long government credit and developed international bonds were the only sectors posting negative returns for the period, down 1.3% and 0.4%, respectively. Turning to U.S. and international equities markets, the S&P 500 index was up 8.1% for the third quarter, led by technology and communication services. As the market continues to focus on stocks benefiting from artificial intelligence, technology was up 13.2% and communication services up 12%. Consumer staples was the lone sector to post a negative return, down 2.4%. The AI rally has sustained for several months, and that is reflected in the one-year returns as communication services up 35.6% and technology up 28.2% led sector results. For the same period, healthcare, materials, and real estate all posted negative returns, with healthcare down 8%, materials down 4.3%, and real estate down 2.2%. Small cap stocks benefited the most from the third quarter's market activity, with small cap value leading size and style returns up 12.6%. Mid cap growth stocks came last, up just 2.8%. For the one-year period, large cap growth stocks posted the largest returns, up 25.5%, followed by mid cap growth up 22%. Looking out globally, emerging markets equities saw another strong quarter, returning 10.9%. Emerging markets outperformed both U.S. equity, up 8.2%, and developed international markets, up 5.4%. Emerging markets in Asia led regional returns for the period, up 11.3%, followed by emerging markets in Latin America, up 10.3%. Europe ex-UK lagged, returning 3% for the quarter. For the one-year period, emerging markets also led returns, up 18.2% versus 17.4% for U.S. equity and 16.7% for developed international markets. Finally, we turn to our market outlook. The Fed has the difficult job of setting rates that balance economic activity, employment, and inflation. While inflation through August has been persistently higher than the Fed's target rate of 2%, and tariff impacts on prices are still being measured, employment numbers seem to be weakening as the Bureau of Labor Statistics nonfarm payrolls reports for the last several months came in below market expectations. However, Treasury markets futures trading shows an expectation of 2 cuts remaining this year. Comments from Fed members have been more circumspect, but reflect an openness to near-term cuts. However, a federal government shutdown began October 1st. The shutdown is impacting the BLS, which produces the inflation and jobs reports on which the Fed relies. At this time, a number of BLS staff have been called back to generate the September CPI report. However, it will be delayed until shortly before the Fed's October meeting. A lack of access to official data and conflicting informal data from outside sources could cause some volatility as we draw closer to October and December's Fed meetings. The holiday shopping season is rapidly approaching. Many retailers stockpiled inventories earlier this year in anticipation of higher tariff rates. While the University of Michigan surveyed consumers remained frustrated with higher prices, consumer spending has been healthy, as noted in retail sales annualized growth of 5% through August, and second quarter GDP growth was also driven in part by increases in consumer spending. However, as the University of Michigan's September report shows, consumers are losing patience with price increases and are growing more concerned about the state of their household finances. The market will be closely watching retail sales reports for clues. This closes our quarterly market commentary for the third quarter of 2025. Thank you for listening.